Great. Thank you all so much for coming back after the break. We have two more panel sessions in store for you, which we're excited about. And we're going to kick off on the topic of financial capability. And this is the first time MMU has ever had a panel on this topic. And I'm very pleased to have two highly esteemed panelists join me and be able to enlighten us a little bit more about what is financial capability. Do we need to care about financial capability? And if so, is there a viable business model to actually make this work, or is this just an activity that will always be philanthropically funded? So just a bit of background before we dive in. I think, Chris kicked us off this morning with some fantastic statistics about the state of mobile money adoption, and I think we could have similar numbers being thrown out on microfinance numbers or even mobile banking. So as we grow and as this number of individuals who are financially included increases, can we just say, great, job done, there's access, or do we have more to go? And so some of the financial education, financial capability literacy out there suggests that the mere provision of financial products is not enough. And that if we are only providing financial products and customers are uptaking financial products, we haven't actually reached financial inclusion. Indeed, this literature suggests that you need the second level of financial capability, where the customer understands, has the skills, has the knowledge to use these products, understands their rights to address grievances, and only then can we say job done and financial inclusion. So in my mind, that's still a debate. Do we need to continue to go all the way? Do we need to do that financial education? Or can we just stop once we've developed innovative products and got it across the country? So let's kick off with Graham and ask you this question. Why do we need to care about financial capability?
I think it depends on who you ask and who responds. But knowing this audience, not knowing it well enough, but hoping to get to know you more, I think it's two things. One, it's an opportunity to increase business. You have a better, more informed client. I would argue that they will use your products more frequently. From a financial services perspective, there's also the argument that financial capability de-risks as well. They better understand how to use appropriate financial products and services, and an empowered client, we would argue, is equally as important as an appropriate client protection regime. I think you can regulate to a point, but that alone isn't sufficient to really create capable clients. A little bit of feedback. So that essentially you have a more financially viable client for you in your business. And obviously you're de-risking from a financial services perspective. At the end of the day, from a development perspective, we believe, and there's increasing evidence that will suggest this, that it actually leads to better household outcomes. But we can speak a bit about that. But that's why I think it's meaningful to this particular audience.
So the statistics I've read are suggesting that in the recent years, there's something like 800 million people who are living under $5 a day who have recently been brought in to the financial inclusion space, whether that's through mobile money or microfinance or conditional cash transfers. But only about 25% were ever exposed to any financial capability. What you're suggesting is that there was actually a financial opportunity missed because those clients, that 600 million, are higher risk and potentially less good customers. Is that right? You're making a commercial argument about this.
Yeah, I think you can make arguments both on the social impact side and on the commercial side, and that's where I think the beauty of financial capability lies. And obviously we could spend hours and would love to spend hours talking a bit about this. We'll reserve that for a different venue, but I think it's both cases. But I think the evidence that suggests that this is still very early days in understanding the business case. Also the evidence on the impact side and what interventions work. At the end of the day, you have to realize your clients are individuals whose lives are not linear. There are ups and there are downs. How do you match financial products and services against that? How do you match the knowledge and give them access at an appropriate time? All of that is very, very, very complex, but this audience understands better than most that the data that is increasingly available, particularly for what you all do, helps us to design interventions in timely ways, in a very cost-efficient way, to address this gap. Effectively, if you were to think about this financial inclusion equation, it's a balance sheet. And the supply needs to be balanced out by the demand at the end of the day. And increasingly, that demand is being recognized as being significant. Last week, Jim Kim at the World Bank, along with Queen Maxima and the other glitterati of financial inclusion, every single one of them, from James Mwangi to, and I have to remember the rest of the people on the panel, Ngozi, the finance minister of Nigeria, all recognize the value of the financial education part of the equation. And that's a sea change. And obviously, Guy can talk a lot more about that from an implementation standpoint, because it's one thing to frame it, it's another thing to how do you implement against that. But I think at a high level, why this is meaningful to this audience, we're just starting to see the value, and one of the things that we're doing at the City Foundation, along with other partners, is investing and demonstrating the evidence of what works and what doesn't, and why this is meaningful, particularly from a business case perspective.
Okay. So before we get into the how, let's stay with the why a little bit longer and bring Guy into this conversation. Do we have specific examples of social impact of financial capability or commercial impact of financial capability where a client is less risky or more empowered to better manage the services that they're using?
Before I answer that question, I just want to step back a little to frame it a little bit more, building on Graham's points. One way to think about whether you want to provide education to your clients to build their capabilities to use your products is to think of a three-legged stool in providing financial services. One is you've got a product. Second is you've got a delivery system. And the third is you've got a client who has a certain level of skills, abilities, a certain level of sense of self-efficacy that they can actually be agents of change in their own lives. So you've got these three stools. If you think that the product you design, the systems you put in place, are capable on their own of meeting the needs and meeting the client where they're at right now, that makes them a loyal, profitable client, then you don't need to invest in financial capability development. You don't need to invest in financial education, because you're going to do it all through your systems and your products. But I think the data on uptake and use of mobile money services would suggest that that actually is not the case, that the product development process, the systems development process is not good enough to bring you to the point where you're meeting your clients where they're at. So that's sort of the framework in which my organization, Microfinance Opportunities, looks at this question. We've done work in financial education in the Philippines, in India, and in Zambia, right around the issue of branchless banking, mobile money. And in fact, in a couple of these projects, and in fact all the three, we found that the products and the systems were not in place correctly. And when we went into these organizations and started talking about financial education, what we found was that it was almost the client was an afterthought, that they had designed the product and the systems and hadn't thought about the client. And when we started talking about financial education, we started to unpack what the challenges were for the clients. And it became quickly apparent that the systems were not working for them, the product wasn't necessarily working for them. So we had an uphill battle to begin with in that. In terms of actually having an impact, interestingly, there are two basic audiences for our impact. Because of the way we do our education, we embed our education into the operations of the financial service provider. That's going to be the how. We'll get to that later. And in doing so, we have to educate the frontline staff, the agents, the bank tellers, as well as the consumer. And one of the impacts we saw immediately was on the agents, the frontline staff, the bank staff. They found that they were better equipped to talk about the product and service more effectively with the consumers as a result of the education initiative. The education was aimed at the consumer, but we had to train the staff to do that. So that's sort of impact number one is, and it's a social benefit in the sense that those people feel more empowered in their positions. It's also a business impact because you've got better frontline staff. In terms of the consumer, as I said, we had an uphill battle with dealing with systems that weren't quite in place. In India, we provided some money management education as well as education around the use of the branchless banking product. And we found in using a financial diaries methodology that there was a change in behavior of women who were exposed to financial education. They showed a decrease in a shift out of borrowing. Based on the data that we have, we saw a shift from them out of borrowing. So that was, and part of our curriculum is around debt management. So that was in India. In Zambia, we have qualitative data that suggests that the people that were using the product were more comfortable, were more confident in the use of the product. And we're looking right now at some data to see whether they changed their borrowing behavior. From the field, from talking to the credit officers, talking to branch managers, what we heard was that the customer was better equipped to manage their loan. They were asking for smaller loans, and they were able to repay on time. We've got to check the bank's own data to make sure that's the case, but that's one of the other impacts.
That's great. So I think you've made both a very compelling case of why this should matter. Let's move a little bit to think about who should be doing it as well, because you've talked about some of the gains being realized by the financial institution. The customers are taking more appropriate loan sizes, they're paying back better, so in effect, commercially, the benefit is going to the financial service provider, whether that's an MFI or a mobile money service. But are they the best placed to deliver this service, or is it other bodies? I mean, we have Citigroup Foundation sitting on the panel. Is it other bodies who are best placed on the topic of financial capability?
It's a very interesting question. It's quite a debate that I don't think we have an answer to yet. I certainly think that there's an inherent tension from a regulatory standpoint, certainly within financial services, about the role of financial service providers in providing financial education, and ultimately, is it just product marketing? That tension exists. We know that exists, and I think that there's an effort underway to continue to come to a common definition and understanding of what the intentions are, but we're not there yet. So that tension exists. So on the business case, though, I don't think you can provide financial capability or financial education services easily through a third-party provider that is cost-effective. I don't think we've seen that model yet. I think the technology platform actually helps address that. There is a bridge there that might exist. There are some examples that we're seeing very early days. Some of you may be familiar with a group called Juntos Finanzas, which is actually based out of the Bay Area. But they have a contract with a Mexican bank to essentially provide financial education to their clients. And they're on a pay-for-performance basis, where the account usage goes up, they get paid more for what they're doing. And it's done through a variety of different technology platforms. I think that third-party methodology does work, but then you also have to talk about who the audience is. If we're talking about children, I think it's a very different set of circumstances, and the political considerations and all of that. Classroom may be the best approach in addition to some other supports. But at the end of the day, there's no one way to do it. We really, I think all of us collectively recognize that it's a multifaceted approach, and it needs to be reinforced time and time again over the life of an individual. So a lot of complicated responses to your very good question.
Guy, you emphasized the point of keeping the consumer at the heart of this, and I think that's really important, not making assumptions that they are completely financially literate, but actually taking the time to understand what are their questions, what are their needs, and how much financial education do they really need. How do you think about, in that three-stool visual that you've so elegantly painted for us, is it one party providing all three components, product design, distribution, and financial education, or are we seeing a more complex landscape shape up?
So within that framework, there are two key players, I would say. One is the financial service provider themselves. So it is their frontline staff who are going to be providing the education and the training for the consumer. But overseeing that three-legged stool are regulators. And regulators have a role. Regulators can look at the content, look at the issue of is this marketing it's okay that education and marketing are not mutually exclusive. In fact, they are often one and the same. What we are concerned about is essentially bad education, duping people into doing things they shouldn't be doing. So a regulator has a role there. A regulator also has a role, of course, on the system side, on the product side, product development side, in terms of monitoring and ensuring that products are not unsafe for borrowers, and systems are not unsafe for borrowers. So in terms of that three-legged stool, those are two players. I would also, but on a broader level, I would also say you have financial service providers, regulators, and you have ministries of education who are going to educate the kids, because eventually they will be the consumers who you're wanting to serve. And then you've got the roles of foundations, NGOs, etc., who are going to be the ones who fund innovation in this space. The debate in microfinance for a long time was, should microfinance be subsidized? The answer to that has come back fairly clearly, that regular operations should not be subsidized, but there's still a case to be made for subsidizing innovations and new ideas, because it's unclear that the venture capital market, the private equity market, those people who normally fund innovations are in the game yet. And that certainly would be true in education. So there's room for everyone, but they have different roles.
Yeah, that's a perfect segue into getting into the how. I've read that it's estimated somewhere between $14 and $20 per education in the typical classroom model. And of course, if we've got to do that for the remaining 2 billion people who are financially excluded, quite quickly that becomes financially impossible. I think that the industry is looking at much more innovative and clever approaches. So maybe, Graham, can you kick it off with painting the picture of what are the possible solutions out there, and then we'll hear from Guy some of the practicalities of this, and highlighting what the role of technology could be.
I think, so Yasmina, to your framing question, when the Citi Foundation commissioned some research by the Monitor Group to help us really understand, because this essential issue, Citi Foundation, through microfinance opportunities and others, has been engaged in financial education for more than 10 years. It's, I think, a natural place for a financial services institution to fit, and we see the value in it. But it wasn't evident to us that it was ever going to reach the scale through a financing model that we had seen, essentially donor money, to ever make a difference, to really not only just a one-time intervention, but a lifetime intervention. So we commissioned Monitor to go out and explore the world. What models work, what models don't? And some of the numbers that you're sharing with us exist in this report, which you can find on the Citi Foundation's website. So I don't need to repeat too many of the statistics, but essentially to say that the way business has been done is not ever going to get to the scale and to achieve the impact that we know is necessary to make more effective financial consumers. So essentially what we have recognized is that the people in this room, and others, but a lot of you in this room are the solution. Technology-enabled platforms with messages and product interventions that are very much influencing behavior, financial consumption, and the behavior of financial consumers. That marriage, that platform, is essentially, I think, the low-cost solution to address this financial capability challenge. And we're increasingly seeing this. So this issue of innovation, philanthropy does have a role in fostering innovation, not scale. I don't think it doesn't exist. And the governments will never have enough money to reach the scale that they need. They can incentivize, but they can't pay for it. We have funded an innovation fund in financial capability to test some of these ideas, and it's global. And some of the ideas that we're seeing now, and it's actually paired in many ways to the Bill and Melinda Gates Savings and Payment Innovation Fund that they have. If you think of that being the supply side, we're in effect the demand side, the Citi Foundation's fund. And it's really interesting because fully, I think, half of the innovation ideas that are emerging are technology-based. SMS reminders, looking at the low-cost SMS reminders and doing a randomized control trial treatment to actually see what's working and what's not. Because it's one thing to innovate, it's another thing to innovate without effectiveness. So to answer your question about the models and how this is ultimately going to work and where the future lies, I think that that's really what it is. Technology-enabled products and services that are designed to change behavior and ultimately in a larger regulatory regime that's favorable to these types of interventions, recognizing that client protection is necessary, but an empowered client with client protection is actually a more effective outcome.
And you mentioned an interesting theme there, that it's not just a one-time proposition,
Right.
but there is actually this ongoing engagement with the consumer. Is that per product, or is that over the life cycle, or how do we
All the
think
above.
about all the above,
Yes.
right?
Well, I mean, I think one of the really interesting challenges is Asia. So if we map out the Asia-Pacific region, you really have two poles. Very developed, advanced economies with mature aging populations. So for instance, we support increasingly more and more programs to help aging women look at pension, savings and insurance programs. And how do you help them understand the myriad products and services that are available, which ones are right for them, which ones are wrong for them, what's cost effective, what's not. Yet you also have countries like Bangladesh and parts of India that it's fundamentally about issues of access to finance. And this is really, I think, emblematic of the challenge that we all have in addressing issues of financial inclusion, where there's no one size fits all, not even just for an individual. That's the challenge. How do you make it so that it's not idiosyncratic, that you put basic principles and frameworks together, and using this phrase of interoperability, which I think is so absolutely right, these platforms. I think that's how you start to resolve some of these challenges about what the individual needs are. Because a young African entrepreneur needs a very different set of financial education interventions than an aging woman from Singapore. It's just fundamentally different, and it's not a one-size-fits-all approach. And how do you model that out is a real challenge. So I think it comes again back to the platform of technology, I think, really being a part of that solution.
So I think the numbers that have been thrown out is that if you can use the technology solution, it's something like 50 cents instead of $14.
The variable cost comes into
Yeah.
play, and it gets really exciting.
Yeah.
It really gets very, very exciting. And it's not even on the cost side. I think the next frontier for us is to understand the profitability side.
Yeah.
Really better understanding, and it's not the profitability of that one-time intervention, but it's the stickiness of the consumer, the loyalty that Guy raises that's really exciting. Because it's so much of this is about aspiration. What this industry does is so profound because it ties into the aspiration. It's this source of energy that we can't generate on our own. It just happens, and you have that power. And if you do that in such a way that ties into this understanding the long-term benefit of these interventions, these products and services, because that stickiness exists, that's measuring that cost benefit, if you will, is much more appealing than just sort of the one-time intervention profit margin, which I think we're still very early days on.
So this is painting the world of what's possible. But Guy, let's bring you back in. Can we
It's the
find
luxury of being at a foundation.
can we find technology-enabled solutions which change behavior, as Graham described, or are these just short-term fixes to a problem that actually is just very costly and we need higher investment to solve?
I'm going to take a slightly different starting point from Graham, which is the way we've been doing our work, especially around the mobile money issue in branchless banking, is embedding financial education in operations, as I said earlier. And that means we are looking at contact points between the consumer and the provider. And wherever those contact points exist, whatever point in the cycle, appropriate education is provided. And if those contact points are technology-based, then technology would be an enabler. You can make the argument also that technology can sort of create contact points through, for example, SMS messaging. The thing that I would caution about that is that part of the way we approach this issue is we also think about how people learn. And people learn by doing. They get a little bit of information, they act on that information, and they get to reinforce what they've learned through practice. And so if you're going to do SMS broadcast messages, you will want to be thinking about, well, what can they do immediately to act on that? And so that's sort of our core approach to this, is embed education in contact points in such a way that the ability to act on the education is right there and then. And in fact, so this embedding idea is consistent with good theories about how people learn, or good, actually it's more than good theory, it's good practice. So that's a key. The place I've been thinking a lot about in technology is these contact points, the work you do at that point. You've got things like, for example, one of the first things you have to do is educate people about, on a mobile money platform, is educate people about what the electronic receipt looks like and what all the information is on that SMS that says, you have sent this money and here's your receipt. People are used to paper receipts, so they've now got an electronic receipt. And they've got to know how to look at that. And in order for you to teach someone how to look at that, you've got to think about, well, what medium am I going to use? Am I going to have a smartphone with it on? Or am I going to have printed materials with it on? And you've got to actually really, it's costly to design that little piece so that it can be effectively transmitted by an agent or a bank teller or someone else to the consumer. So I've been thinking about the technology in terms of how can we lower those back-end costs so those contact point moments are cheap. Another example is use of posters. Put them up in an agent's shop. The posters provide some sort of information. It may be for an illiterate audience, so you have to have pictures. And how do you design that poster? Do you hire a highly skilled designer each time to put that poster together? And you've got, 100,000, 200,000 places you want to put that poster in different settings, in different cultures. That's expensive. So those sorts of scale-up questions, to me, is also another place where technology matters. Can we somehow use technology to make those things cheaper?
Fatima on the panel earlier talked about a 72% illiteracy rate in Afghanistan, and we know a number of markets we work in, and of course the populations we're targeting do often have relatively high illiteracy rates. We heard also from Muad'Din about Bcash, where they think of those 75,000 agents as a frontline customer engagement touch point. Are you also considering models where in your three-stool design the delivery component is both delivery of the product, but also in some way delivery of education?
Yeah, so the agents would be the front line.
Yeah.
So those frontline staff, those agents, those bank tellers, whatever is your touch point with the consumer, you're doing it through someone who is providing the mobile money service themselves. And so they're playing a dual role. And this is where the marketing issue comes in, is how do you change that agent from someone who is simply providing a service in a passive way to someone who's proactively engaging the customer in a process that moves the customer from getting over the very scary move of using the service to then using the service more often, recognizing how it might help them manage their lives, to moving them to using the service in ways that actually change their own money management behaviors more profoundly. So using the service to increase their savings deposits, using the service to move savings out from under the mattress into the electronic account. That's a graduation model that requires a different set of tools at each touch point, and it requires an agent who is able to recognize where that particular customer is at, have the tools at hand to provide the education, and then move them on. And I would argue, and we are also trying to move to a results-based financing model. I would argue that it's good for business because it's about creating loyal customers. And some of you who are in marketing or in training of frontline staff probably already are thinking, yeah, we kind of do that already. Yes, but is there more that can be done recognizing where people are at right now?
One final question before we open it up to the floor is a bit more forward-looking. We've heard some great arguments around the commercial benefits of financial capability. We've heard some nice stories about the social components as well. We're now talking about it being a lifetime process with the consumer always in mind and needing to engage them at different points. Graham, you said philanthropic capital is best at innovation but not scale. Where are we on this stage? Where are we on this continuum? Are we still in the innovative test and learn approach on financial capability? Or do we have enough proof points from the things that Guy's talking about that we now need to be up into that scale stage?
So if you were to hear us, and I think our generally common message about where the frontier is, we are very much at the frontier. It's nowhere even close to scale. I think there are some, if we were to look at financial education in a very different way, some scale, I suppose, from traditional education systems, not very effective, and I don't know that we really understand what that's accomplished, but that may be a bit more at scale. But at the end of the day, citing the statistics that you did in terms of the number of people who have been financially included, largely because of mobile, we would add, and how one defines financial inclusion is not relevant for this particular panel. And maybe at best 25% of them receive some form of financial education, and oftentimes, and actually in that model, we did not look at mass media, which is an important component of this conversation that we didn't touch on a lot in terms of reinforcing message. I don't think we're anywhere close. So Guy referenced this pay-for-performance issue, and I think that is very much where we're headed next, and that we look at interesting development impact bond structures, for instance, as a way to front-end the development of some of these systems that are not going to be paid for on a variable cost basis. It's just not the way it's going to work. That's where a role of philanthropy, development finance needs to come to play, and frankly, commercial money. This is really, in effect, R&D. And if the financial institutions and the MNOs recognize this early enough, they're going to solve a riddle that needs to be solved. They're just going to do it well in advance of everybody else. And that stickiness factor, I think, comes into play in all of this. It comes down to this frontline issue. I've seen this time and time again where you have a frontline worker who's out there selling a product. If you layer on education and you don't have the financial incentive to back up the time and effort that they're providing in that, they're going to not provide it. They're going to move on. They're just selling the commodity. And the moment that the balancing act occurs, we've seen this in financial education with some of the big MFIs in Bangladesh, some of the big names that everybody's familiar with provided financial education at one point. But when a competitor came in at a lower cost loan that didn't require financial education, all the clients went to that. So where's that value add? Where's that stickiness? Where's that client interaction? That to me is the real frontier. It's figuring out the finance thing is not the innovation. That'll be figured out. It's this other part of things that Guy is working on and others in this space that really will unlock the finance. That follows. It's the business model that we still need to work on.
Guy,
No pressure.
anything to add? What should the private sector be doing at this stage, and where is philanthropy still important?
Philanthropy is still important in terms of the innovations. In terms of the private sector, the evidence base is thin. We are still experimenting, and part of that is because, as I said before, we're working in a situation where there are so many other problems beyond the capabilities of the client. There's systems problems and product problems. So, but I think that our answer to that is, let's talk about financial capability development because it puts the consumer at the center, which will bring that product and systems process together. So, if you don't change the capabilities of the consumer, you will still have impact because of these other changes. That's the sort of worst case scenario. So I think that there is a case to be made that financial service providers, MNOs, should be investing in this. There's also, it turns out that as things are evolving on the regulatory side, they're going to have to do this. They're going to, there are so many governments, so many central banks that are requiring financial education as a part of the service delivery process of financial service providers that, you don't have a choice. So then the question you have to ask yourself is, am I going to do it properly, or am I just going to take a curriculum off the shelf and say I'm doing it? And this is my fear as someone who's promoting good financial education, is that what we're going to find is service providers just pulling something off the shelf and saying, we'll tick that box. And so that's actually, that regulatory push has real consequences for scale, because that can scale things, but it can scale things badly. So it's one of the things that's keeping me a little worried.
Great. Well, with that concern, let's bring in the audience to the conversation and see if we have any questions. I think we have time, and great. So we're going to invite Monique, who's well versed on this topic.
Yeah, Monique Cohen. I want to go back a little bit because we heard a lot of discussion about education in the previous panel, and yet you've all both talked about education, but nobody's talked about what are we educating people about? What is the content? And I think that most people here probably think of financial education as debt management, budgeting, and savings. And I would like to suggest that maybe we are on the wrong track, or we should think about other things, because we're dealing with a population that lives in a world of risk. And because it's risky, they look at mobile banking as a rather risky affair until they're comfortable with it. So it seems to me that we need to really start with getting people comfortable, trust, and build confidence, build those two things, and then follow with other things. People will figure out what they want to do with mobile banking, but in essence, the first step has got to be building trust around, Guy said, paper receipts, PIN numbers, a variety of things. They've also, one of the priorities of your poor is the service has to be timely. Banks are not timely. And you've got to also think, and safety we know, and we have to find a way to do that. Because I think, if I've understood this audience correctly, the real objective is usage and number of transactions. So that's how we're going to get there. So I'd like you to comment a little on that.
You want to go?
Well, I was just going to your point about trust, I think you're absolutely, Monique, you're spot on about that issue. In some of this research that we're funding in Mexico, one of the main, because so much about the mobile platform is about access. It's the delivery of financial products and services and knowledge. And on the receiving end is the awareness of what that is. But if you can know what it is, it doesn't mean you trust what it is, either what's being given to you or how it's being given to you. And we've seen this in this innovation fund around conditional cash transfers, which many of you may be familiar with, are these huge channels of money being funneled from governments to individuals, conditioned upon behavior change, often related to health and education. And what we're trying to do in this, or we, not the funders per se, but the people in the study are trying to actually create rainy day savings accounts in parallel to the receipt account in this conditional cash transfer program. Because, as we know, so many people's lives have risk and they don't have insurance, and they want to create a savings account effectively as an insurance mechanism. But the recipients of the CTTs historically take the money out as soon as they receive it, because they do not fundamentally trust a government program channeled through maybe a private bank, but that's maybe controlled, in fact, by the government. So how do I know that that money's actually safe there? So this issue of trust comes into play, because really what you need to do is message and build trust and loyalty to what that product and program is. And that's what this study is. I think it's emblematic, again, of it's not just about the product. It's about the experience, and it's not just about the knowledge. It's about the trust to use this stuff. Because you're absolutely right also about the usage piece, particularly for this audience. That's the measure of success in so many ways. So that's just, I think, somewhat helpful as a way, a proxy to answering your question.
I would completely agree. I mean, the trust in the system as a whole, and trust in some of the basic delivery processes. So, as Monique mentioned, PIN numbers. people in our research, what we found time and again is people say, what happens if I forget my PIN? Or there are also issues around, what if I lose my SIM card or my phone? Do I lose my money? I mean, these are big issues. If they're putting, $10 or $20 on, that's a significant amount of money in their minds. And the idea that they might lose their phone and lose their savings at the same time is really a problem for them. And so you have to get them over that. The interesting thing about that is that there's a business case for building that trust. It's branding, it's effective customer service, it's quality management, it's the fundamentals of good quality management. In terms of the confidence, enabling someone to know how to manage the system that they're putting themselves into. Again, from the market research and from our research, hearing that people don't know how to use the number to call for if they have a problem, and also training the staff on the other end of that call to ensure that they fully understand the customer and the problem that they're encountering. Those are simple things that can be done. And so there is this, as I was saying before, there's this graduation model. You start with the trust and the confidence, and you build them through to other things.
It strikes me when it's, sorry, just your example, when Citi helped first develop the first ATM.
Yeah.
What that first interaction experience must have been like. Here, I'm going to put this card into a machine, punch in some numbers. God only knows where that information is going. They're going to give me cash. Is it my cash? And how does that all flow? It's effectively the same thing. It's just 20, 30 years later. And you have to build that trust. And that wasn't done through financial education funded by government or foundations.
No.
Banks saw that. They saw the value. And Citi put R&D money into marketing dollars into that. So I don't know why that we have to reinvent our thinking about this. It's just the business model that's different.
Great. Well, we've only had 30 minutes, and we've tried to cover a huge range of topics about financial capability and hopefully introduce some questions and not just answers. I think there's been a really nice theme here around why you should do it, and is it just good business sense? And I think both of you have offered us some really nice insights into the reasons behind that, de-risking clients, empowering clients, thinking about the life cycle of clients and making sure they're empowered and educated to take the different products that best meet their needs. You've also layered on the threat of regulation, that if we don't do this, there's that risk factor that we may be pressured into doing that as well. And then we've had a nice discussion on some of the how, and how much can technology bring that cost down, but keeping in mind that people learn by doing, and how do you facilitate technology-enabled behavior changes, but also ensure the customer gets that experience, and dealing with the illiteracy issues by empowering your frontline staff. So I think there's been some really nice themes discussed here, and hopefully answered many of the questions the audience has had. So that just leaves me to thank both of you very much for having shared so much insights. So please join me in thanking Guy and Graham for this excellent panel session.
Thanks, Mina.